Discovery Investing panel, looking at the challenge and opportunity of Africa's world-class exploration. So I'd like to invite the panellists to join me on stage. We'll be moderated by Charles Bond, partner at Gowling, and he'll be joined by Joe Mazumdar, economic geologist at Exploration Insights, Willem Middelkoop, founder and CEO at Commodity Discovery Fund, and John Meyer, partner and head of research at SB Angel.
Thanks for joining us for the Discovery Investing panel. So this morning we're going to be talking about the challenges and opportunities for Africa's world-class exploration. And we've got a really good panel here. Sorry, we're missing one today, but I'm sure we'll make up for it with the rest of the panel. We're going to kick off straight away with some of the factors that are making exploration more challenging for mining companies in Africa. And what are those factors? I mean, normally a lot of the accountants and everyone else comes out usually with a key issues list every year. So I thought we'd try and get our own key issues on the table. Although I think I'm going to say to the panel, let's not mention money to start with. We'll come back to that. That's obviously a key challenge. But let's talk about some of the other key challenges. And I was going to kick off first because it's very thematic around the critical minerals issues and what impacts that's having on exploration, especially around areas like lithium, etc. Where does this create uncertainty now in the exploration environment? So I'm going to kick off first with Willem on that because I know that's an area of your interest. Having written a book about it recently, which you can plug shamelessly. So, Willem, do you want to start on that one?
Yeah, I think the big change is that we're moving away from the unipolar world centered around the US dollar to a multipolar world. And what's very interesting is that the war in Ukraine has been a catalyst for a great divide between the West, the allied countries, and the rest of the world. We have over 140 countries not joining the Western sanctions. That's all countries in Middle America, Latin America, Africa, Middle East. So now the Western countries decided that they don't want to be dependent on China any longer for the critical metals and the battery metals. So there's this great fight now for all the projects which are still available, especially the battery metals. If you look at graphite, or cobalt, there's not much lithium in Africa, but there's really a fight now to get their hands on those projects from the West, and that's the biggest change.
Mm. And it's not just presumably the actual assets, but it's the processing of those and where you're going to send them, etc. I mean, do you think it's making it more difficult now? I mean, if you're a junior and you're thinking, I want to go and get some lithium in Ghana or something like that, is that now a difficult decision because you don't know where the politics are going to go, whether the country might nationalise the lithium industry, etc.? Is that a real issue, or will people still take the chance?
Well, we should look at the different metals because Africa, most discoveries in Africa which have been made is in gold, and Western Africa is all about gold. It's not about lithium, but you have some battery metals like graphite, like cobalt, but that's most in the DRC. Which is of interest, but and another interesting point to note is that Africa is the only place where, if you look at all the dollars spent on exploration, the output is larger than all the money which has been spent. So in Africa, it's still a great jurisdiction to discover stuff.
And I think resource nationalization is yesterday's story.
Right.
I know Mexico said they wanted to run all the lithium out of Mexico, but that's really it's more likely to be perhaps a Latin American thing than an African thing. We generally find African governments are more sophisticated now and more pragmatic. What worries me more to do with Africa is the fact that South Africa's running military exercises with Russia, that Wagner Group are moving into certain parts of Africa, which I think could be problematic because they work off a completely different set of morals and rules to everybody else in the world. So I think there's going to be a little bit of tension there, but probably not too much because the Wagner guys tend to be in places where we won't go anyway.
Right. So West Africa still a difficult place for explorers, or?
No, actually a good place. Yeah.
Yeah.
And also, many novice investors are always afraid for all these coups.
Yeah.
But these coups never change a lot for the miners.
Yeah.
You know, they just go on and they pay fees to another, group.
Well, you mentioned Ghana, and they are really sophisticated. It's a little bit expensive for small companies to get into with the bureaucracy, with the processes, because it's really been orientated towards working with larger mining companies, but very, very advanced and sophisticated from a mining perspective, and very keen to have more value add in country. So if anything, that is the trend, I think. No, it doesn't really affect the exploration side of things too much, but if we have seen, I mean, there was an announcement yesterday from the Minister of Mines in Ghana saying, working with an explorer, bringing in a lithium refinery company and saying, yeah, we like this combination. We want to see value add in the country. And it's not just Ghana, it's Tanzania as well. Yeah. And I suspect others will follow.
Yeah. So they're not getting too worried about taking any of these projects and nationalising. That's good. So no expropriation. Joe, you run investor news sheet for your community. Well, it's
never been called a news sheet.
Okay, sorry. It's a subscription. What kind of feedback are you getting from your clients on political risk in Africa?
Well, I would say, like, I wrote that piece in the essay, and what when you do your research, you sort of find out that right now, in terms of exploration expenditures, if you take the peak of exploration expenditures on the countries that actually have any exploration on them, I mean, on average, 35% of their last peak over the last 15 years, depending when it was, and a lot of those peaks were in 2012. Like some countries, like Eritrea, which I visited, a while ago when Bisha was running, Zara, Sunridge and all that was going on. Right now, Eritrea is seeing about 5% of that exploration budget that they did in the peak. And so, if you follow the money, you know where the interest lies. Mm-hmm. And right now, Eritrea is not getting a lot. And so when we talk about Africa, it's like we don't say South America. We talk about Argentina, we talk about Chile, we talk about Brazil. We don't say South America. Yeah. So when we talk about Africa, you gotta, like, when money moves, like right now, money is moving, I think, outside of Burkina Faso, but it's going into Cote d'Ivoire and Senegal. Same gold, same belts, but probably for some people less risk, because you might feel comfortable, but somebody who's giving you the money might not feel comfortable.
Yeah, so, well, the good news is it sounds like it's relatively benign at the moment. So let's talk about other risks for and opportunities for the junior miners. We've got to talk about ESG, I guess, and the impact that's having. John, because you're regularly dealing with the juniors, they're having to talk about ESG. Is it having a real impact on their spend, for example?
It's very easy to dismiss it for juniors, for explorers, but in reality, you've got to start ESG early. Even if you're just drilling or you're geosensing, you're running IP surveys, that kind of thing. You're doing stuff across people's land, sometimes across their fields. You need their agreement. You need these guys to be happy, and you need to ensure that you clean up afterwards. And you need to prepare the ground for the future project. So if your exploration is successful, you don't want to have generated a bunch of hostile local people who are upset because you've been drilling in their backyards. You need to set this so that, let's say you sell the project and the next guy comes along, he's walking into an environment where the locals are saying, welcome, come and be with us. Let's look forward to this project. So you need to be talking in advance about what the potential can be without getting these guys overly excited. You can't set too high expectations, but you've got to be really careful. And there's some fantastic examples of this. We knew a company, they were in Cameroon. They went into the villages and said, we're going to do some work around here. And they gave the chief some money. The first thing these guys did was buy guns so they could go and fight the other villages.
Yeah.
you got to be so careful. So what they did after that was they set up trusts and bank accounts and ways of administering the money. So you have to be so careful about how you go in. You can't just make everyone a millionaire like they do in the States with the fracking, which of course makes those guys very popular. No, it has to be done on a really intellectual level.
Willem.
I agree, but it's way less important for the exploration space than the producers. And this also has to do with the type of investors. If you look at the producers, you have also institutional investors being investors in the producers. And they all have their ESG, criteria. If you look at exploration, it's much more a world in which you find high net worth money. And we are a resource fund specialized in the exploration space. And we don't have one institutional investor. It's all retail money, high net worth money. And it's not a big issue. So there's a big difference.
I would say the goal in any exploration company, because they're not going to build the project or produce, is to get taken out.
Yeah.
And so I would say like I've been doing exploration since the late 80s. Social license was always important, because if you didn't have social license, you couldn't access the project. So all these people that talk about social license now, it's existed for a while, because you'd never be able to do anything without it, whether it's in northern Canada, whether it's in Australia, whether it's in South America, wherever, even in the States. And so if you don't have that, it doesn't matter if the federal government gave you a permit to access that ground. The rancher wouldn't let you in, or the community would be hostile to you. And I'll give you an example quickly. I used to work in Patagonia, and there was a project there. I came there with Rio Tinto, or RTZ at the time, and all the locals wanted jobs, and they didn't know anything about mining, and we were just doing grassroots exploration. They said, when are you starting to hire people? When's the mine start? And I thought, well, hang on a second. And so when another company came in, bought a project there, they stayed very close to the community. They didn't say what they were doing. They wouldn't interact. And it left the window open for an NGO to come in, show them some pictures of a tailings dam failure in Spain, got them all worried about the tourism there, and because there's a lot of fly fishing there, and skiing, and they went solid, like it's never going to happen. And like basically 20 years later, they've ruined it for any mining company in that province.
Is there, the juniors you speak to, John, when they come to you and say, what have we got to do on ESG? Yes, it's grown right now, and there are advisory groups out there. Can you go, if you're a junior watching this, and you're thinking, what the hell do I do? How do I actually do something tangible here? What should I put in place? Are there advisory groups to help with that?
Yes, the good thing is that the industry is growing. You see some of the accountancy firms now running ESG advisory divisions, which I guess they bolt onto their other services. And then you've got Jamie Strauss running Digby, which is very much orientated towards what the investment funds are looking for. And so he's offering a service where you set a baseline early, and then the investment funds can see how you improve. And it's not so much exactly where your ESG is at a certain point in time. It's the pace of improvement that is going to be important going forward, so that BlackRock, Fidelity, and the others take a look at this and go, yeah, these guys are doing good stuff on the ground. It might have been really toxic to start with, but it's looking better now.
But the BlackRocks and the Fidelities aren't investors in exploration companies. We never see them on the register.
Yeah. What's interesting is those same funds would be talking ESG in one fund and then investing in Peabody Coal in another fund.
Yeah.
So take it for what it's worth.
Yeah. So it can be a selling point, but it's as you progress, by the sounds of it, you've got to just keep an eye on it.
Look, you can boil it down to a box-ticking exercise, but because that's how you simplify stuff. But in reality, the funds need to be able to argue that what they're investing in is creating some improvement. Yeah. And what we all know is that companies that are good at their ESG are more successful overall because they have less trouble with their communities.
Okay, let's move on to other issues affecting miners. Obviously, the world's been a high inflationary environment, large cost pressures over the last couple of years. Has that affected any of the juniors?
Yes. So drilling costs have gone through the roof. The problem really, a lot of it's in terms of exploration. We're not talking development. We're not talking production.
Yeah, exploration.
Labor availability on the rig. So you can get a drill rig, but you can't get the best drillers. And so when you get ineffective drillers, it costs you more because they screw the holes up and blah, 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 blah. And then when you put that onto remote areas, it gets even more expensive. And so that your dollar doesn't go as far as it used to because of that. But I would say one of the big issues has been labor.
Yeah.
Not just geologists, but more so like drillers and assay labs.
Yeah.
That's been huge, and that's been a thing since COVID and continues to be. And for juniors that need to raise money on the back of results, but now they have to wait 3 to 5 months for results, it's harder to do.
That's the average.
Well, it's not
wait
the
for-
average, but some people on the extreme side. I mean, I knew of a company in Nevada that was drilling for gold, and some of their assays for gold were in Laos because the lab had sent them all over the world and trying to get them assayed somewhere.
Yeah.
That may be because of certain types of gold would be
Right.
better processed in certain assay labs.
No, this is all Nevada, Carlin. There's nothing. I mean, anybody could do it. It's just that it went to Laos. But I'd heard that before.
Yeah.
I heard that people didn't know where their assays were, and then they would get, this part of the hole and not that part of the
But
hole.
that's hard for juniors, right? They want their results out quickly. They want to generate the interest, and they're just not getting the assays back.
Yeah, but it's also hard on regulatory, because you get the hole, and then you say, well, I don't want to release that because in context, it's not really the good stuff. But people will say, oh, it's a dead hole, but it's really this part that I want, but I can't get it.
So here's a question which I think a lot of the juniors face, which is, should you be drilling in a time where money is tight, or should you be looking to find other ways to boost your share price? Because you've got to spend a lot of money putting that hole in the ground. And then often, certainly in London, what we see as soon as results are out, the share price drops because everybody sees it as an opportunity to sell. So is drilling worthwhile?
I think, frankly, you've got to see your way through the cycle.
Yeah.
Because the guys that do really well are the guys that keep drilling. And then when the sector picks up, suddenly they've got results that they're able to put in front of investors and say, look, guys, look what we've done over the last 10 years. And, okay, it's been tough raising the money and it's been a hard slog, but they're there. Whereas the guys who are just picking it up, they're behind the curve.
Yeah, fair point.
But I think there's an existential problem with the financing of junior mining companies, exploration companies, because we shouldn't forget that we started a fund in 2008. That was the top of the last cycle. All the people working in our company only experienced the bear market. So many, and actually, if you look at the Toronto Stock Exchange Venture Index, it's still 80% down since 2008. And so many retail investors were burned and lost their money. So it's very, very hard for junior mining companies who don't have a sincere discovery, a significant discovery, to do a real serious financing. So I would like to make a call that we need to find new ways to finance exploration companies. And some companies like BHP are taking up the initiative to give out grants.
Explore,
And I think especially now the Western countries are united in their struggle to be less dependent on China. We'll need some money coming from Brussels or Washington to kickstart several projects.
We're seeing that on the development side, like in terms of the Department of Energy, Department of Interior, proposing lending to critical mineral projects. But what I see from the juniors is not the idea that I'm not going to drill, but the idea that I'm not going to do that technical report.
Right.
Yeah. So one thing that they're scared of is putting a capital number out there. So they don't want anybody to see that.
And this high inflation environment, capital numbers aren't worth anything because within 2 years you can do it all over again.
Well, your point, Willem, probably brings us on to the second question, which is about, are investors ready to deploy riskier capital in a volatile market? It sounds like your answer to that is probably not at the moment. But it depends, I think, on what market you're looking at. I mean, you know, Australia's had a really good run over the last couple of years, and they seem to, you know, still have that appetite. What's your view across the different markets?
Well, we're one of the very few groups who really put a lot of money into exploration companies, really the early stage stuff, sometimes even pre-discovery. But we stopped doing that. Because it's much smarter to cover. When we started, we only looked at North America, Canadian listed companies. Now we invest 30% of our money in Australia because the best discoveries are being made there, because there's so much to be discovered. It's under sand cover. So we changed our strategy to make a list of the 100 best discoveries, most significant discoveries worldwide, metal agnostic, and only put more money into the real significant discoveries, and don't take the Eric Sprott barrel shot approach by giving every junior a few million and hope they will be successful.
Look, every investor has a different strategy. Yeah. It's tough getting money for exploration investment. Funnily enough, it seems to be easier to get stuff for the small private early stage companies at the moment. But then you've got to be careful of that, because sometimes you can raise the money and in some other environments you can't. So the race is, when you're a small private company, is to get listed, because when you're listed, you can pretty much always raise money. It might not be as much as you want, but it's usually enough to get you to advance what you're doing. And then the successful companies we've worked with over the years, they've just carried on through the cycle, and eventually it happens. And so we're working with quite a number of these that normally we're only interested in listing them once they've found a bit of something, and we really want them to make a bit of a discovery before they get there, or at least be very close to it.
And do you think retail are going to come back into the market any time? I mean, or as Willem said, they've had their fingers burned and they're going to wait.
No, we do see it. I mean, they have their favourites. You know, in the UK, Cornish Lithium, massively supported by retail through crowdfunding and stuff like that. Will that take off? It'll be interesting to see how much more of that comes through. I think for the moment, it's still more family offices, professional investors.
But a bull market always brings back retail, because you see it with the hype now in lithium, and you have crypto-like returns, and it always attracts retail.
What's the market like in Vancouver, Joe? Is that?
It's not like very easy to raise money, but there's companies that are doing good work that have been able to do bought deals and raise money in January. I mean, the key months in the year on the TSX to raise for a junior are January and March, because you want to raise as much money as you can for the field season.
Yeah.
Tends to be. Right now, because of the volatility during COVID and everything else that was happening, more companies are trying to raise for 2 years and not just one field season, so that if the market turns down, they can still deliver news flow the next year. So the problem with some of these companies is when they just budget and raise for that budget, is if they don't hit, then they have to go back to the market, and they might have to raise at a discount to where they raised last time, which does not please previous shareholders.
And there's also a change in the amount of money they are doing in a financing round. A few years ago, let's say 5 years ago, the average size of financing was maybe 2 to 3 million. Well, in the current high inflation environment, that's just enough to pay the salaries and the lights on. So when you have a serious discovery, you need to do a financing round of at least 10, 20, 30 million. And especially in Australian markets, you see that companies being responsible for a significant discovery, they are raising 30, 40, 50 million right away. And when your discovery holes are good, you can get that money easily.
And is it still the same sort of raisings? Is this all equity, or are you seeing any alternative forms of capital for explorers?
Yeah, the convertible deals are very interesting, and that's Warren Gilman who used to be with BMO. and was a banker in Hong Kong. He worked for Li Ka-shing, Asia's richest investor, and he invented a way to construct deals around exploration companies with convertibles that you don't have the downside and you do have the upside. And that's a very interesting area. And I-80 just did a 50 million or 60 million convertible
That was
deal.
their second one. Yeah. So so they have private equity in Orion Mine Finance and Sprott. Because like Willem says, when you really want to do something, you don't want to have to keep going back to the market. And if you want to do something big, those institutions can't do the small things.
Yeah.
They can do the big things. And so that quantum, but you need a story. And you've got to give people a story that appeals to them, like a strategy that makes sense over 3 to 5 years that almost fits with their fund.
Yeah. Are you seeing anything else, John, that's novel at the moment in the financing side?
Well, I think that the involvement of the majors back into this space
Yeah.
is important. And, for example, Anglo-American have been looking at putting $100 million back into ARC Minerals in Zambia. If they do that, that will be a big, big vote of confidence for a major company to go back into that region. We know Rio Tinto have committed money to Moonstone there. We know, First Quantum have obviously built more mines recently in the region. So there is a lot more happening again.
Yeah.
And yeah, I mean, it's definitely there are other pots of money coming into the space, which is important, partly driven by the fact that the Chinese are coming in and snapping stuff up as well. Look at the deal by Hainan Mining to acquire, well, not acquiring Kodal Minerals, but acquiring half of their project. Very sweet deal, $100 million for 51% of the project. Rest of the company is free and unencumbered. They then get another $17 million at twice their share price at the time. We didn't see deals like that before. This is extraordinary.
Yeah, when equity's tight, right, I guess you go and look for a cornerstone or a strategic investor. So are the majors doing team-ups at the moment with juniors? Are they helping to fund?
Well, we've got one in Nevada that they did a deal with Newcrest, which is now Newmont.
Yeah.
So
Not yet, but
and that's a deal where you do each project, put a staged earn in.
Yeah.
The junior would show the investor like, oh, Newmont is, or Newcrest, that they're basically saying, okay, these guys are going to invest $40 million in my project. Hey, look, I've got a market cap of 15. If you read into the details, it's sort of like, okay, I'll spend 5 this year, then blah, 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 blah. But for a junior company to be able to do regional geophysics, do several surveys, all the soil samples you want, and not worry about your budget before you actually drill is huge in terms of generating high-quality drill targets and not having to go back to the market all the time.
Yeah.
What's interesting about the new company, Newmont and Newcrest, is that Newcrest was doing all the deals Newmont didn't dare to do. And now Newmont understands it's much smarter to buy Newcrest and buy extra reserves and extra production, because that's way cheaper than to develop that yourself.
Yeah, well, that's what you'll see. And I mean, I don't think that this merger and the last one between Yamana with Pan American and Agnico is sort of like saying that we're going to have a slew of M&A. It's more these guys trying to consolidate, get a big reserve base to basically attract more value investors so they could generate the dividends that they started off trying to offer people. And it's no longer about growth, because now for Newmont it's been impossible to grow. I mean, it's ridiculous. I mean, you can't find those kind of deposits every day. Yeah. And so the only way and Newcrest gives them a big long reserve life. What we'll see right now is a lot of divestments and potentially new projects and companies taking some of those assets off the market.
And it's not just the traditional mining majors now. You've got General Motors putting money into. I mean, this is the battery metal space, and it's very hot at the moment. Piedmont with a big offtake agreement with Atlantic Lithium, and there's so much of this going on. So knowing that you've got a huge offtaker behind you that's really, really keen and is going to put up a lot of the capital for the project, that pulls new investment in. So these small companies especially in the lithium space. But this will also happen in nickel. We know about it in cobalt. There isn't much of that, but graphite, I suspect, will become the next lithium. It's all happening. It's pulling new money in because people are pretty confident they're going to get a good return out of that.
Yeah, I think. Sorry, Jay.
Yeah, I was just going to say, like, another place that's been a source of money is, they've been doing all these conferences in Saudi Arabia, and that's been a big source. But from what I understand, most of that money is going to be spent there.
Yeah.
They generated conglomerates that'll do resources, and then they'll develop their own resources.
Yeah,
they're bidding against Ivanhoe Electric for projects within their own country.
Yeah, I attended that conference. It was pretty fascinating, actually, to see what was going on. But they're clearly bringing together all the majors to cooperate and do the technology transfer, the know-how transfer. All that looks like it's going to get invested into local projects to start with.
But I'm wondering if that spills over into Egypt and other places in the Arabian,
the
Nubian
GCC,
Shield.
Yeah, I'm sure that's right.
Which would be interesting, another source of capital.
I'm not quite sure they're ready to invest in exploration yet. I'm not sure the Saudi mindset is risk capital.
I think what they're trying to do is get production, so they'll go into development projects.
Yeah. It was interesting. There were a couple of juniors out there sniffing around for money, but
from what I knew, some people that went, they were directly invited to go, and I mean, I didn't go, but I heard that there was more chandeliers there than bathrooms.
Yeah, it was impressive. So I guess we've got a bit of time left. So the penultimate question is, which explorers are best positioned to make the critical discoveries on the continent over the next few years? Do you think having that large major as your joint venture partner is going to put you in a better position than being maybe a lone wolf and trying and doing it on your own?
I would say it depends on the jurisdiction.
Right.
Because if you get a good jurisdiction like Namibia, Botswana, some of these ones, you don't have to worry that somebody's going to ask you about that country before they invest. If they need to see 5 slides on why you're there, then that's not someplace you want to be.
Yeah.
What you want to be able to do is say, hey, this is a project and they're comfortable with Namibia or wherever the country is. And then you might not need a joint venture partner. Yeah. You can bring it up yourself because you could always potentially attract capital. But if you're in an iffy place, it's nice to have that rubber stamp by a major to say, hey, it is an iffy place, but I'm okay with it. You need that stamp of approval more.
Yeah.
I don't agree fully on that because if you have a great project in an iffy place, to use your word, then it's still needed. We've seen a recent study for the battery metals, and now the EU decided that all cars which will be sold after 2035 needs to be electric to supply enough of the battery metals. We need 70 new lithium mines before 2035. This can't be done. But you know that every lithium project which has some size will get developed, and this goes for many of the battery metals. So I think even the iffy places will see development.
Yeah.
Counter. The only thing is about, like, if it's growth in the States, because I've got a project in a nickel one in Vietnam, and for them to do a deal with a cathode manufacturer in Korea, one of their problems is trying to find out if the components or the ore or the metal comes from Vietnam, can it get the EV credit from the States? Because the EV credit is based on either being domestically produced mineral, or component. That's half and half. And they only do it domestically or a free trade agreement country. And they don't have a lot of free trade agreement countries.
So there's been a bit of a land grab, obviously, and now people are slowing down, working out, what am I going to do next? Where am I going to actually ship this stuff at the end of the day?
Yeah, and that's why you see the U.S. government going around and trying to do, deals in Zambia and the DRC to try and make sure that they can get some of these.
A couple of points I'd like to cover. 150 years ago, it was hard getting around the world. If you wanted to go across the Andes or you wanted to trek through Africa, you were on your own. There was no support. it was a very different place. The discoveries that were made were easy discoveries so long as you got there. You kind of fell over the project. It was sticking out of the ground. Today, it's very easy to get around. Everybody's got a mobile phone. It works in the middle of the Congo. You know, you can get Wi-Fi off Elon Musk's Starlink if you really want it, and it doesn't cost you that much either. So there's the whole thing has changed. If you want to, you can drive up to most projects now on roads that have recently been built by the Chinese. If you've got a project that you develop, you can easily export through a whole number of ports, either to China or somewhere else in the world. So all that side's become much easier. The difficult bit is that the really easy discoveries have often been made, although I'm sure there still are some more pretty obvious discoveries to be discovered out there. But now we have drone technology for remote sensing. Now we've got, if you want a drill rig on a site, you ring up one of a dozen companies, it can be there within a few months. They may struggle with getting some of the experienced staff, but I'm sure that will come. So it's actually much easier to put this together, so long as you've got a good idea of where to look.
So do you think to be in a better position to be a junior, you need to have better technology?
Well, the technology's here.
Yeah.
I mean, the technology that they fly over the ground now is awesome. You used to have big helicopter surveys, and it used to take ages to crunch the data. Yeah. That is so much cheaper, so much faster to do. It's a guy with a backpack, and he can upload the data. It can go off to an office somewhere. It can come back, a whole series of charts really fast, and this says where you start drilling, and that has to speed up the exploration process.
Yeah. Fair enough. Okay. We've got one bonus question then, which is the difficult one, which is it possible to carbon neutral any of the projects in Africa, especially the more remote projects?
Well, there's so much sun in Africa in general, if you compare it to the Netherlands, where I'm from. So I've visited projects where they have these huge sun farms, and they even give back power to the grid. And when the mine life will be finished in 5 to 10 years, the sun farm will still be there and will be hugely beneficial for the region.
Yeah, so when I worked for Newmont, and we worked in Ghana, and that it was a lot of heavy fuel oil, which is almost the worst. Sometimes in Ghana we got grid power, but it was load shed, and you can't do that in a mill. Yeah. It's hard to shut it down in the middle and keep it going, so you have to have backup generators. They were all diesel. And so you need total redundancy there. I saw a big transformation in a place like Chile. Like when I used to work there in the 90s, I mean, there was coal, there was natural gas coming from Argentina, and then when the Argentines cut it off, they went all to renewable. And now you see solar fields all over the place, and they have enough power that they could actually export it.
Right.
So it's like you get to the point where you can't do anything else, and you do something like that, and now power is not the issue. It's still water, but power is not an issue. So you might need that kind of moment where somebody says, hey, we're going to just invest in this because we have no option, and that's definitely what happened to Chile. They definitely have the resources to do it. It's just having the capital.
Yeah. And what about the water? How are they going to overcome the water?
The water's actually the bigger thing with the E. Yeah. And that goes from the western states all the way to Chile. Chile's in like the 10th or 15th year of a drought. Yeah. In the States, if no mine can compete for potable water, you're just not going to get it. So having water in a lot of projects in the States is like number one. And you can't have any of this stuff called Waters of the United States, which would require a federal permit because a lot of those projects have been put on ice.
Okay. John, anything else? So from an investor perspective, how important does this say on the front cover of your presentation? You're going to be a net zero explorer.
It's really difficult to be a net zero explorer. I mean, you can make net zero mines, but at the end of the day, drill rigs run off diesel. Okay, you can generate electricity for the camp from solar. You could even put up some windmills and stuff like that. But it's difficult to be net zero when it comes to grassroots exploration.
Fair enough. Okay.
But it's not a big emitter, let's face it.
Yeah, that's true. Thank you very much to the panel. Really grateful for your input today. Thank you.